How to start investing with $1,000, a beginner's no-threshold practical guide. Do you think investing is only for the wealthy? Holding just $1,000 in your hand? Are you waiting to save $10,000 before starting? 10 years ago, I just graduated as an administrative assistant, earning $3,000 a month. I scrimped and saved to get $1,000, but left it in a savings account, earning a meager 0.4% interest, watching inflation erode its purchasing power. It wasn't until I tested the waters with that $1,000 that it has compounded to $8,500 today, still growing at around 10% annually. Don't underestimate this $1,000. It's not pocket change, but the first brick of wealth compounding. According to S&P 500 historical data, the average annual return over the past 30 years is about 10%. Starting with $1,000 plus $100 monthly contributions, it will grow to $125,000 in 20 years. If only kept in a savings account, it will be just $15,000 with principal and interest in 20 years. Today, as someone who's been there, I'll show you how to easily start investing with $1,000. No complicated jargon, beginners can follow directly. I must do before investing. 2 things to build a financial safety net. Investing requires no worries. Don't rush into the market with $1,000. First, do these 2 things. 1. Prioritize an emergency fund. An emergency fund is the moat for investing, covering unexpected events like job loss or illness to avoid being forced to sell assets at a low point. Aim to save 3 to 6 months of essential living expenses. For example, $4,200, $8,400 for $1,400 monthly fixed costs. If you haven't saved enough yet, set aside $1,000 separately as an emergency fund, separate from investment funds, and deposit it in a high-yield savings account. For example, Ally Bank, 4.2% annual interest rate. For easy access, I covered unexpected surgery costs with my $2,000 emergency fund back then without touching my investment principal. 2. Pay off high-interest debt first, then invest. Use $1,000 to pay off debts with an annual interest rate exceeding 15%. Credit card debt, payday loans. This is risk-free, high returns. For example, $1,000 credit card debt with a 25% annual interest rate accrues $250 in interest a year, far exceeding the average investment return. There's no rush to pay off low-interest debts, 3% mortgage, 4.5% student loans. A friend of mine invested $1,000 instead of repaying a student loan with a 4% annual interest rate. The annual investment return not only covered the interest but also generated extra profits. 2. Choose the right account. Don't waste free tax benefits. In U.S. investing, choosing the right account equals saving big money. Beginners with $1,000 should focus on 2 types. 1. Retirement account, IRA, a tax shelter for long-term investing, suitable for retirement in 20 to 30 years with 2 options. Traditional IRA contributions are tax-deductible. Taxes are paid when withdrawn in retirement, ideal for those with high current tax brackets. Roth IRA contributions are not tax-deductible, but both principal and earnings are tax-free after retirement, perfect for young people. The $7,500 profit from my $1,000 investment 10 years ago is completely tax-free. The 2024 annual contribution limit for IRAs is $7,000. So $1,000 is more than enough to start. Open an account with Vanguard or Fidelity. 0 fees, $0 minimum deposit, and completable online in 10 minutes. 2. Regular taxable account, a flexible universal option. Choose this if you may need the money within 5 years. Saving for a down payment, travel. It has no tax benefits but no withdrawal restrictions or penalties. Open an account with Robinhood or Webull, which support fractional shares, allowing you to invest in high-priced stocks with $1,000. For example, $200 for 1/8 of a $1,700 Google share. A colleague of mine invested $1,000 in fractional shares of 4 stocks, earned $300 in 2 years, and withdrew it directly for a house purchase with no constraints. Key reminder: avoid high-fee accounts. Steer clear of brokerages charging $5, $10 per trade, or $50 annual account fees. $1,000 principal can't afford such costs. Insist on zero commission, zero account fee platforms. 3. How to invest $1,000. 3 portfolios for beginners to follow. Core principles: diversify risk, low fees, long-term holding, don't bet on single stocks. Choose based on risk tolerance. 1. Ultra-conservative investment horizon, 1 to 3 years. Allocation: $700 in a high-yield savings account, 4.2% plus $300 in a short-term bond ETF. For example, BSV. Returns: stable annual return of about $37, almost no risk of loss. Suitable for beginners with no experience who fear losing principal. My cousin chose this for her first investment, earned $35 in a year, and later added $150 monthly contributions. 2. Balanced growth, investment horizon 5 to 10 years. First choice. Allocation: $600 in a total market index ETF, for example, VTI, plus $300 in a bond ETF, for example, BN, plus $100 in real estate, REITs, for example, VNQ. Returns, 8% to 10% annual return. $1,000 earns $80, $100 a year, about $1,500 in 5 years, and $2,600 in 10 years. Logic, VTI diversifies stock market risk. BND provides stable dividends, and VNQ hedges against inflation. I used this portfolio 10 years ago, and my $1,000 has grown to $8,500. I didn't sell during the 2020 crash, and it fully recovered later. 3. Aggressive. Investment horizon, 10 plus years. Allocation, $700 in an S&P 500 index ETF, for example, VU plus $200 in an international market ETF, e.g. VXUS, plus $100 in a tech ETF, for example, XLK. Returns, 10% to 12% annual return. $1,000 earns $100, $120 a year, about $3,000 in 10 years, and $9,700 in 20 years. Risk may lose 20% to 30% during market crashes, but long-term holding ensures recovery. A friend of mine lost 20% on VOO in 2022, didn't panic sell, and recovered his capital when VOO rose 24% in 2023. Now he's profitable. Key reminder, don't invest all $1,000 in individual stocks. Individual stocks are extremely risky. You may lose all principal if the company goes bankrupt. Index ETFs are baskets of assets. For example, VOO includes 500 large companies, significantly reducing risk. 4. Practical keys. 3 details that determine your earnings. After choosing the right account and portfolio, these 3 details maximize returns. 1. Choose low-fee products. Reject hidden costs. Fees are the invisible killer. A fund with a 1.5% expense and 0.03% expense, investing $1,000 for 20 years. The former grows to $5,700, the latter to $7,300, a $1,600 difference. Beginners should prioritize index ETFs with an expense ratio 0.1%, such as VTI 0.03%, such as VU 0.03%. Low fees plus high liquidity deliver obvious long-term compounding advantages. 2. Set up automatic contributions. Overcome human weaknesses. Don't try to time the market. No one can accurately predict the lowest point. I waited 2 months for VOO to drop, but it kept rising, costing me an extra $120 to enter. Correct approach. Set up monthly automatic contributions. For example, $100 deducted from your paycheck on the 5th. Buy more when prices are low and less when high to average costs and avoid emotional decisions. I now set $400 monthly automatic contributions. No need to monitor the market, saving time and making money. 3. Hold long-term. Reject frequent trading. Investing isn't speculating in stocks, it's letting money work for you. The S&P 500 declined in 10 of the past 30 years, but there's never been a loss when held for more than 10 years. Too many beginners sell when up 5% or panic when down 5%. Frequent trading fees plus missed opportunities often lead to losses. Remember, the core of $1,000 investing is compounding. With a 10% annual return, $1,000 earns $610 in 5 years, $1,600 in 10 years, and $16,400 in 30 years. Success lies in persistence. 5. Pitfall Guide. 3 common mistakes for beginners. 1. Falling for high-return scams. Don't be deceived by claims like 20% risk-free annual return or insider stock tips. The USSC prohibits legitimate investment products from promising guaranteed high returns. A neighbor of mine lost $700 to a cryptocurrency mining scam. 2. Investing with living expenses or leverage. Never borrow money or use next month's rent, grocery money to invest. Investing involves risks. Losses will disrupt your daily life. A colleague of mine cashed out $1,000 from his credit card to invest, lost $300, and had to pay interest, falling deeper into debt. 3. Chasing ups and downs, focusing only on short-term returns. Don't go all in on assets that soar short-term. For example, a cryptocurrency up 50% in a week, they usually crash. Short-term volatility doesn't equal long-term value. The S&P 500 never rose 50% in a week, but it's grown 20 times in 30 years. Final thought. The true meaning of investing with $1,000. My current investment portfolio is $118,000, but I'm most grateful for that $1,000 10 years ago. It not only generated returns, but also helped me develop the habit of saving and investing and understand the power of compounding. Many people think $1,000 is too little to invest, but all great wealth starts with small amounts. Starting with $1,000 now builds investment thinking. When you have $10,000 or $100,000 later, you won't be confused. Take action now. Spend 10 minutes opening an account with Fidelity or Vanguard. Deposit $1,000, set up automatic contributions, and forget about it. Check back in a year, you'll thank yourself. Investing is never a privilege for the wealthy. It's the best way for ordinary people to fight inflation and achieve financial freedom. $1K isn't much, but it helps you take the crucial first step. Remember, the best time to invest was 10 years ago. The second best is now.